Okay, well, so much for that prediction. Last week on this show, we did our election edition of Dollars and Cents, and we predicted that this election you might very well see a repeat of what happened back in the year 2000, where you did not know who won or lost until about 30 days and a court decision had passed. It seemed like this election was sort of setting itself up for something very similar. So much for that. AP called the race the next morning after the election. I think if I remember the timing on it, was about 5:30 in the morning on the day after the election. So, of course, that means now that we know what actually happened here on this post-election episode of Dollars and Cents, we have much to talk about, much to sort through, and certainly we'll have some thoughts on all of that. Plus, of course, election season, like many other headlines these days, it certainly creates a few distractions to keeping us all consistent on our investment objectives. Now that the election is behind us, we're going to talk about some of those other types of human behaviors or human biases that can prevent you from achieving your goals. And most importantly, how do you overcome that? How do you manage to get around that? So welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast. So make sure you check us out on your favorite podcast channel or even our YouTube channel as well. If you have any trouble finding us on any of those platforms, go to our website, nelsonfinancialplanning.com. Bunch of icons that will be readily apparent. Click on the one that looks most familiar to you, and then you'll get automatically connected to our channel on that platform. Once you're there, make sure you subscribe. Then that way you don't have to do all of those steps again. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks, all of whom happen to be certified financial fiduciaries as well, that stand ready, willing, and able to help you improve your life with a successful and cost-effective financial plan. So the election has come and gone, I guess, thankfully, most clearly, not the undecided outcome that we were predicting last week on this show. And I guess that underscores yet another reason in the host of reasons to not try and predict, or should I say, base investment decisions on what you think might happen in terms of an upcoming event, because this really was a unique week, particularly when we think about the market's reaction to sort of how everything played out on Tuesday. Sort of one of those things where we go back to that old expression, invest when you have the money and not try and time the market. That often is a big mistake. But certainly as humans, we certainly do it on a regular basis. So let's take stock of sort of where things are at this point. The Republicans, it looks like obviously they're going to be in the White House, going to have control of the Senate. The House still looks skinny, but it looks like they will have a slight majority there as well. The majority, the slight majority in the House, hopefully that might prevent or provide some level of gridlock, depending upon how skinny that actual majority is. That gridlock scenario, we've talked about that certainly in years past or episodes past here on the program. That gridlock scenario is often sort of the best one, right, for the markets and the economy, because that means that the pendulum's not swinging too far in one direction or the other. So I guess if that margin in the House widens and Republicans have a greater margin and sort of, in essence, unchecked control of the House, then I guess you might, if you're a Republican, you might want to be careful about what you wish for, so to speak, because if you got all three of those in your pocket, then it gets hard to blame the other party, right? So I think, be careful what you wish for on that. But clearly safe to assume that over the course of the next couple of years, based on a lot of what was said this campaign season, there's definitely some concepts that we will see that are going to get some focus on that have a direct impact on your money. Chief of them, of course, is income taxes, estate taxes. Most likely, you're going to see the current tax rates continue to continue beyond the end of next year, 2025, which is when they were currently slated to sort of revert back to where they were previously. So expect, obviously, a lot of conversation about taxes, a lot of changes there. And similarly, on the estate tax exemption side of things, probably not probably not going to see as big a changes as what might have happened in terms of that estate tax exemption. Although I would not be surprised, regardless, where you see some adjustment of that number. I think that estate tax exemption, with the inflationary increase we were talking about last week on the program, set to be almost right at $14 million for next year. That's starting to get a pretty significant number. And at the end of the day, it does beg the question of, how does Washington pay for all of this, right? I mean, if you keep low taxes, if you keep estate tax exemptions high, then you're not collecting much estate tax, you're not collecting much income tax. How do you wind up kind of making all the numbers work, if you will? So always an issue there in terms of what you're trying to accomplish. Student loan forgiveness, that's probably dead on arrival now under President-elect Trump. Prior administration, Biden administration, forgave $175 billion in student loans. But hurt them more than it helped. Who knows, as they start to, they'll be breaking down this election for weeks, months, and years ahead to figure out what went, what won the day and what lost the day, for lack of a better expression. In terms of our view on that, if you search our archives, you know that we're on record. Particularly having gone to public school for college, paid off any student loans. The other thing that I always kind of suggest in this conversation is, when you think about colleges and universities, where's their responsibility in all of this, right? I mean, they're kind of selling an overpriced product, and where's their accountability for that? Why is it only the taxpayer, especially when a lot of these colleges and universities are sitting on endowments worth hundreds of millions of dollars? Now, oh no, that's the endowment money. That's different. That's different. Well, it's the same institution, and you got control of the money. So I have a strong opinion sort of on that. It looks like the student loan forgiveness will effectively probably come to a little bit of a dead end on that. Child tax credits, currently at $2,000. If you have a child below a certain level of income, below a certain age, then you get a $2,000 tax credit. Expect that to expand. Suggestions were all over the map, but you could certainly expect that to expand as well. So those are probably the three sort of chief, more immediate financial and tax and retirement-related aspects to it. But against that backdrop, right, so you had the election on Tuesday, and then on Thursday, the Federal Reserve meets. So we got to talk about that too. But we got to take a break first. So stay with us through the break here on Dollars and Cents, and we'll be back to continue to break down the events that wound up being a very busy week as it relates to your wallet. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we're working through the events that were this week. Obviously, primarily of those was the presidential election and also the election for all of the members of the House and a third of the members of the U.S. Senate. Talked a lot about that before the break in terms of the implications. Obviously, you would expect to see some movement on taxes, income tax rates, estate tax rates, a decrease in student loan forgiveness, an increase in child tax credits. Those would be kind of some of the central themes that you would expect to see play out here over the next couple of years. In addition to that, of course, there was the Fed meeting this past week as well. And on Thursday, the Federal Reserve met and I guess here's the key. And if you're regular listeners of the program, you know we've said this before. You know, the unelected body, because you didn't elect Jerome Powell as chair of the Federal Reserve, that unelected group of folks probably has more direct influence on the economy than what you went to the polls for on Tuesday. So on Thursday, the Federal Reserve proceeded to lower rates by another 0.25%, that coming on heels of a 0.5% reduction back in September. It was a unanimous decision. So at this point, no cracks in the Federal Reserve's approach or direction in terms of interest rates. I'm not sure that necessarily moved a whole lot. If you look at the data on mortgage rates from the week prior, average mortgage rate in America had trickled down to about 6.1. This past week had actually jumped up to 6.8%. A lot of it is some concern over deficit spending and having that continue. We do have a problem in this country. It is called our deficit. Nobody wants to talk about it, but the bond market doesn't really care whether you want to talk about it or not. It is pricing accordingly. So one of the things that you saw happen was that bond prices went down, and that would reflect the fact of if there's more debt outstanding, more bonds to be issued, then the bonds aren't going to be worth as much. On the flip side, if you're familiar with how bonds work, it's sort of that inverse relationship. When the price goes down, the yield goes up. So mortgage rates, for example, jumped from 6.1 on average to 6.8 just in that 2-week period of time. So the bond market clearly is focusing on the debt and the deficit, particularly as it reacted to what was going on in terms of the other headlines this past week. The Federal Reserve lowering interest rates didn't necessarily move that needle a whole lot one way or the other. And as you said on the program, sort of minimal impact on sort of the average American. The average American, the outstanding mortgage right now is sitting at a rate of about 3.9%. So that's an American consumer that isn't as troubled by the current mortgage rate environment simply because they're sitting at 3.9%. What it does do is, as the Fed does cut interest rates, it lowers the rate that you're getting on your cash savings, your money market accounts, savings accounts, those types of things. So in essence, that continuing trend of lowering the interest rate is going to force many folks to sort of have to look at other options, maybe even investing that money. So that was the big headline number 2. There was a third headline that actually just happened on Friday as well. Before we get to that, though, we want to welcome in all of our listening audience to Dollars and Cents. This is the show where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast. Make sure you check out our website, nelsonfinancialplanning.com. There, you can schedule an absolutely free conversation, and we do not have account minimums. Why, you may ask? Well, because we're here to help, and we want to help you no matter where you are on your financial journey. I know many other firms say, you got to have $500,000, you got to have $1 million to come in and talk to us. I don't know how that could be considered being a fiduciary for the investing public, if that's really kind of the lines that you're drawing in the sand. I would submit that someone with $10,000 probably needs a little bit more financial help than somebody with $10 million, right? Don't you think? Anyway, my name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries, standing ready and able to help you improve your life with a successful and cost-effective financial plan. So, I mean, the headlines alone, I mean, as you might well expect, right? It was an election week. But beyond the election, you had a Federal Reserve meeting where they cut rates by another quarter point on Thursday. And then on Friday, you may not have seen this story, but 2 of the 30 components that make up the Dow Jones Industrial Average change. So what that means is that when you look at the Dow, or that Dow Jones Industrial Average number, what you're looking at is a price-weighted average of the 30 different companies that make up the Dow. So in contrast to, say, the S&P 500, which is market cap weighted, the bigger the company is, then the more it drives the performance of the index. For the Dow, it is based on more about price per share of that individual company that helps to drive up what's going on in terms of that average. So as is usually the case, every few years you'll see some companies getting dropped, other companies coming in. Usually that's because of bellwether companies, because the Dow is generally thought of as 30 kind of, bellwether names, if you will, in terms of the types of 30 companies that make up the Dow. 30 of the largest blue chip companies, I guess would be the other way to sort of describe it in terms of those companies that make up the Dow. Well, as those companies see their fortunes, kind of ebb and flow, then what the folks at Dow Jones Industrial does is that they swap out different companies if performance is lagging or things like that. So NVIDIA, so on Friday, in the Dow Jones Industrial Average, you had 2 of the 30 companies sort of get swapped around. NVIDIA, which is now going to be part of the Dow, replaced Intel, which is interesting because Intel sort of is a company that was a well-regarded company, but sort of missed out on all this AI stuff. And so that has hurt its performance. And so NVIDIA is getting swapped out, or Intel is out, NVIDIA is in. Similarly, Dow, which was a component of the Dow Jones, Dow, the chemical company, a much smaller company due to a variety of spinoffs that they have done over the past few years. Replaced by Sherwin-Williams, a 158-year-old company. Yes, that's who is on your paint can. They make paint along with various coatings and whatnot, all in sort of that chemical-y type of industry. But the Dow replaced by Sherwin-Williams as well. NVIDIA would rank 22nd in terms of price weighting out of 30, whereby Intel was last. What's interesting about this historically is if you look at this, companies that enter, their performance sort of drags going forward, because to enter the Dow, you had to have had a pretty good performance over the course of the past few years to grow to the point where you would be considered to be included in the Dow. And then on the flip side, if you're an existing component of the Dow and you sort of get kicked out, chances are, you might have fallen into some tougher times, rougher days from a business perspective that led you to getting kicked out, because the inclusion or the exclusion of a particular company in the Dow is sort of a rear view exercise, right? So if I'm Intel or if I'm Dow and things haven't been going well, then okay, you're out the door. If I'm NVIDIA or Sherwin-Williams, okay, things have been going well, so you can come in and replace these. But what happens is generally the ones that get kicked out wound up kind of having having an improvement, and the ones that get put in wound up having slower growth. There's a bunch of studies on that. So, but anyway, obviously a significant week beyond 2 of the 30 components of the Dow being swapped on Friday. Thursday, Federal Reserve changing rates, lowering rates, and then, of course, Tuesday, the election. Let's hope next week we can all kind of catch our breath a little bit after this past week. We're going to continue here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So, certainly in the more than one occasion, we heard from folks in the weeks and months leading up to the election that expressing concern about that uncertainty or the uncertainty associated with the election, and use that as a reason, or should I say excuse, to not move forward on trying to accomplish your or their financial goals. And certainly human behavior, one of the single biggest determinant of your long-term investment results. We share with you on this segment how big of a behavior role those human behavior biases can have, or how many people as a percentage of the population actually have these biases, and they then consequently influence a lot of the decisions that people make. And then we'll talk about how you counteract that. So all of that coming up on this segment of Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast. Make sure you check us out on our website at nelsonfinancialplanning.com. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries who stand ready and able to help you improve your life with a successful and cost-effective financial plan. So, human behavior, such a major influence on long-term investment results. We've shared with you this before, but it's why Chapter 1 of our book, Next Gen Dollars and Cents, which we're holding up for our YouTube audience as well right now. That's why that's the first chapter in the book. Chapter 1 of our book talks about human behavior. Obviously, copies available on Amazon. If you reach out to us between now and the holidays, we're running that holiday special, whereby if you ask the office for a copy, we will be more than happy to send out a free copy of Dollars and Cents, Next Gen Dollars and Cents, in order to maybe give that to a loved one or give that as a Christmas gift. Excuse me. So, human behavior. The book, Chapter 1, that's why the book starts out on that very topic. The reality is that, excuse me, the reality is that that's a major part of what influences our investment results over time. That's why we started out the book with that first chapter about human behavior. And yes, in fact, I did write the book that was not AI generated. I think that's a question you got to ask anybody these days when they come out with a book. That one was written by me, yours truly. Anyway, here are the stats before I keep coughing and choking here on the program. On the 4 most common types of human behavior biases. Okay, so the types of human behaviors or biases that influence our decisions based on surveys, the number one that the most amount of investors had, to the tune of 88%, was that 88% of investors admit to having an availability bias. So that's a bias of basing decisions only on readily available information, right? So you don't, unfortunately, that means you're not going too deep on what it is that you're trying to figure out from an investment perspective or a financial perspective. And obviously there to counteract that is to make sure that you're becoming more educated about your finances, to understand things like exactly what your underlying investment allocation is all about those types of things where you've got to really dig a little bit deeper and not just take the information that's readily available and then create a conclusion from that. Nearly 90% of investors fall sort of prey to that availability bias. The next one, which is almost 8 out of 10, 78%, find that they have a fixation with a confirmation bias. And I guess that makes sense, right? You always want to be told that you made a good decision. You always want to be told that you made a right decision. But that confirmation bias can just be confirming what wasn't such a great decision in the first place. And certainly in today's worlds, with feeds being what they are, particularly on our phones, then it certainly reinforces that confirmation bias. So make sure you're taking the time to educate yourself. Make sure you're taking the time to seek professional guidance. Because if you're getting validated too easily, you might want to take a moment and get an independent perspective in order to offset that. The next one at number 3 on this list of the most frequent behavioral biases that people have, this one's almost at 70%, and that's being loss averse. Frankly, I thought this one would be the number one sort of behavioral bias that impacts people. But when you are risk averse or loss averse, you opt for less risk in a portfolio than you probably should. And no one wants to lose money, but the problem is that if you are not invested the way that you should be invested, to at least have some portion that is on the growth side, then it prevents you from achieving the investment results that you need to achieve your financial goals and objectives. So, and then lastly, for 2/3 of the population, and again, this one's probably higher, particularly over the course of this past week, 2/3 of the population gets distracted by recent events, and those events then influence the decisions that they make. Certainly pretty applicable this week, given the election, Federal Reserve decision, all of that. So don't be easily swayed or influenced by recent news and events. So these biases have some commonalities, and certainly want to think about some of the ways in which to sort of combat them. The biggest probably distraction of which is the election, but that's now behind us. But there'll be headlines tomorrow that will equally serve that same function of causing you to put off some of the financial decisions that you should be ultimately doing. So, so the 3 ways in which you can sort of overcome these human behavior, these normal human biases. Number 1, understand the details. As is always the case, we talk a lot about on the program, make sure you're educated, make sure you have good perspective of what is going on, and take the time to really dig into what your actual investment allocation is going to be. And that will help you overcome perhaps the loss averse bias. It'll help you overcome that availability bias as well that we talked about. Number 2 is obviously seeking professional guidance. That's a good way to certainly avoid that confirmation bias, because if you are seeking professional guidance, hopefully that's going to be independent guidance and fiduciary-based guidance. And so if it is, then you should be able to get a better perspective on what it is that you're doing from an investment perspective. And then lastly, reduce the noise. We talk about this all the time on the program. Hopefully now post-election, this might be easier to do, not having that distraction of what is going on in all the headlines that's occurring on a regular basis. But that's a lot of human behavior, human biases. 9 out of 10 people have the availability bias. 8 out of 10 investors fixate on confirmation. 7 out of 10 investors are loss averse, and 2/3 of investors are distracted by recent events. Those are the 4 most common biases that you see in human beings. How do you overcome them? Well, it's about understanding the details, becoming educated on what it is that you own from a financial perspective. That will help to overcome that loss, that bias against loss aversion, that availability bias. Getting professional guidance obviously helps as well to overcome the confirmation bias, getting that independent perspective on whether what you're doing is on the right track or on the wrong track, and then helping to reduce the noise. Hopefully now post-election, you may be able to do that a little bit better than what you were before the election. So with that, we're going to take a break and continue on here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So regardless of what actually happens over the course of the next few years in Washington, involving your retirement, involving your taxes, all of those issues, there's a couple of significant changes that are scheduled to occur, courtesy of legislation that was passed all the way back in 2022 called the Secure 2.0 Act. The Secure 2.0 Act had a lot of provisions involving retirement, how you save for retirement, what types of accounts you can use in retirement. And there's provisions that when that bill was passed that were scheduled to sort of come on board over the course of a certain number of years. Well, one of those years is 2025, which is obviously coming up. And this involves the amount of the catch-up limit, the catch-up contribution limits that you can have once you're above certain ages. And then, and this one, although this one has been delayed even further to the year 2026, restrictions on where you can actually put those catch-up contributions. So welcome on into the program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Check us out on our website at Nelson Financial Planning. There you can schedule an absolutely free conversation. In addition, because it's the holidays, you know what that means. We offer our book Next Gen Dollars and Cents absolutely free of charge. Don't go to Amazon and buy it for $14.99. Give us a call at the office at 407-629-6477 or visit our website. Reach out to us through our website at Nelson Financial Planning. More than happy to send out a absolutely free hard copy of our book to you and yours. Talk about an ideal holiday gift, right? The gift of achieving financial success. That's a worthwhile gift, right? That's better than a gift card or a sweater or whatever else is on your Christmas list. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we stand more than willing to help you improve your life with a successful and cost-effective financial plan from me and the whole team at the office. So, changes for 2025, actually passed in 2022, the biggest of which is the catch-up contribution. So currently, if you're over 50 years of age, you can add an additional $7,500 into what you're funding, your 401k, your 403b, or your 457. So there's an extra amount that if you're over 50, you can put in up to an extra $7,500 into those types of accounts. Starting next year, if you are between the ages of 60 and 63, that $7,500 number goes up to $10,000. Just for that narrow age range, that catch-up contribution goes up to a total of $10,000. So be aware that if you're in that age range, 60 to 63, then that starting next year, you're going to have the opportunity to do even more of a catch-up contribution to help get your retirement savings back on track. And then similarly, although this one was supposed to start in 2025, it got delayed till 2026, where you can put that catch-up money is going to be determined by how much money you make. If you make over $145,000, then you're going to be having to put that catch-up contribution in on the Roth side. And what that means, basically, if you think about the difference between Roth versus IRA, or to the traditional side, when you put money in, you get a tax deduction. When you take it out, it's fully taxable. A Roth sort of works the opposite way. When you put that money in, then you don't get any particular savings on your taxes at that point in time, but the savings comes in retirement. When you take it out, then it is tax-free. In this particular case, you're forcing higher income earners, which are in higher tax brackets, to not have the option to make those catch-up contributions on a pre-tax basis. Instead, they must do them on an after-tax or Roth basis. Now, again, that was supposed to start next year, 2025. It's been delayed to 2026. Here's why they do that, right? You don't need me to tell you this, but here's how that works out, right? If you force someone who's making a bunch of money, and if you're making a bunch of money, you're in a higher income tax bracket. And so if you force them to do the Roth only for those extra catch-up contributions, well, then you've just raised their tax bill, because now they're putting that money in on an after-tax basis and ultimately now paying the taxes on that now, when more likely than not, they might be in a little bit higher tax bracket. But those are the two big changes coming up, coming online, going back from the year 2022 when the Secure Act passed. So just be aware of those changes that are coming up as well. So I guess some deep breaths on the general public at large, right? I mean, that was a busy week between the election, followed by the Federal Reserve meeting, followed by the changes in the Dow. 2 of the 30 companies in the Dow getting swapped around, NVIDIA in the place of Intel, Sherwin-Williams in the place of Dow Chemical. That's a full week. So catch your breath. Hopefully you weren't overly troubled, although I think half the country was overly troubled with the results of the election. The other half wasn't. The reality is that there's another one in 2 years, and it'll be here quickly. It'll be here before we know it. And ultimately, that's kind of how the process goes. The sequence, if you will, of elections occurs on a pretty regular cycle along the way. I guess the other comment that I would make in as we get to the final minutes of the show here is we've certainly seen it. In the 25 years that we've been doing this, we see it a lot, where you hear politicians on both sides of the aisle say stuff on the campaign trail, and then what actually happens is the reality of governing kicks in, and that can really produce some very different results, some very different outcomes that aren't nearly what was said on the campaign trail. And when I think about this and kind of how the political scene changes every couple of years, I think that's important to remember, particularly in a close election like what we saw this past week, although at the end of the day it wound up not being overly close if you kind of look at the numbers. But still, I mean, you got almost half the country voting for one person and a little bit less than half of the country voting for the other. That's still pretty close. It wasn't 60% to 40% or 70% to 30%. The biggest changes happen more from the reality or the practicality of governing. And we've said this before, perhaps the biggest change to your retirement actually came out of an innocent change in the distribution rules that was included in part of the tax cuts of 2018, specifically these distribution rules related to inherited retirement accounts. We've long said that that's one of the biggest tax increases on your money, and it was a relatively innocuous change, but what it did was it shortened the distribution time period that a beneficiary had to take all of the money out of a retirement account. And as they're doing that, of course, they pay taxes. So when you shorten the distribution window from the rest of their lifetime to a 10-year period of time, what do? You effectively increase the amount of tax dollars that are going to be collected on that same amount of money, right? Versus spreading it out over a period of time by concentrating in a smaller period of years, then you are more likely to have those distributions hit or trigger higher marginal brackets than they might otherwise see. And we tell that story here, sort of at our post-election episode of Dollars and Cents to just understand some perspective, I guess, if you will. You really have to see how all of this is going to play out before you jump to any kind of conclusion one way or the other. Needless to say, I'm sure we're going to have much to discuss in the weeks and months and years ahead here on Dollars and Cents, particularly keeping you updated on what should be a bunch of income and estate and retirement related tax changes. So stay tuned for future episodes on that. And with that, we're going to wrap it on up and get on out of here. If you have questions, give us a call at the office to set up a free conversation. Or if you have a topic that you'd like us to talk about here on the program, happy to do that as well. Again, just reach out to our website, Nelson Financial Planning. And remember, we don't charge for those conversations. And unlike so many other firms, we don't have account minimums, making us truly here to help. With that, we'll wrap it on up and get on out of here. This has been Joel Garris of Nelson Financial Planning on Dollars and Cents.
Well, all right. You have yourself a good weekend.
All right. Sounds good. Happy birthday to your wife.
Thank you very much. Be good, dude.
All right. We'll talk to you.